Welcome to this episode of Ignition Time. This is a special episode where I educate you about financial preparation for the next pandemic. Now, the whole concept of the next pandemic was actually brought up by a British host, John Oliver, on HBO on his show Last Week Tonight. Pretty interesting segment. He's a pretty funny guy. Let's actually show you this segment about the next pandemic because the warnings about the pandemic we face now were around many, many years ago. Let's roll the tape and check out what John Oliver had to say on his show Last Week Tonight on HBO. Let's check this out real quick.
The most important time to talk about this because scientists attempted to warn us about the next pandemic long before the current one hit, and we didn't really listen. In fact, 17 years ago, just after the SARS epidemic was contained, a leading scientist was on 60 Minutes sounding a chilling warning.
What worries me the most is that we're going to miss the next emerging disease, that we're going to suddenly find a SARS virus that moves from one part of the planet to another, wiping out people as it moves along.
Something more lethal than SARS is what worries you.
That's something to be keeping you awake at night.
Yeah, it is, because that is a hauntingly spot-on prediction there.
It's funny hearing a British guy talk. It's almost as funny as hearing an American Indian guy talk. But folks, in this video, I'm going to educate you about my investment strategy and how you can plan financially for the next pandemic. There are fundamentally 4 concepts that I'm going to go over with you. I want you to be a better educated investor. I don't want you to be an investor who makes emotional decisions, who follows something like a short squeeze, like a GameStop, who tries to follow the flavor of the day, and then you're not quite sure why you're not experiencing long-term success. For me, long-term financial planning, the kind of planning that has allowed me to get through this pandemic and the kind of planning that will help you get through the next pandemic, is going to involve 4 components. The 4 components are structure, cost basis, target, and tax implications. When I say structure, I'm talking about how you structure your portfolio in the stock market. When I mention cost basis, I'm talking about the average price of the stocks that you own. Did you get in high? Did you get in low? Did you dollar cost average as the stock was dropping? This is very important to your long-term financial success. When I use the word target, I'm speaking about annual returns. Are you achieving a certain measure of annual returns? I'll be covering that as well. And finally, tax implications. You must understand the difference between short-term and long-term capital gains tax when you sell your stocks. Now, this is going to be a very important video, so I encourage you to watch this video all the way through to the end, because I'll give you my entire investing strategy and I'll show you my portfolio and what I watch every single day and how I manage my own multi-million dollar portfolio. So before we jump in, let me show you a quick disclaimer and then we'll dig right into the concepts of financial planning for a new world, for the next pandemic, for a post-pandemic world. So folks, I need to read you a disclaimer. This is not just for me, but this is to help you become a better investor. So I appreciate your patience while I get through these points really quick. Neither Ignition Time nor our subsidiaries or any of our respective officers, employees, affiliates, representatives, agents, or independent contractors, which I'll refer to as Ignition, are in any capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Neither do me or my team provide any investment advice or financial advice or make investment recommendations, nor are we in the business of conducting trades on your behalf. Ignition cannot and does not make any guarantees about your ability to get results from anything that is shared on this channel by anybody on this channel, and there's no guarantee you'll earn any money with our ideas. You might actually lose money with our ideas, so please be aware about that. All services from our company are for educational and informational purposes only. The personal investing examples that you'll see on our channel are just designed to demonstrate how certain things work. They're not designed to ask you to do the exact same things. They're designed to educate individuals and solely for an educational purpose. They are not representative in part or in whole of the consistent returns of our accounts, or for that matter any account. There should be no expectation of future gains. Now, Ignition or any of our companies or representatives might have positions which are both profitable and unprofitable, so keep that in mind. Now also, neither the information that is provided by Ignition or any of the opinions that you'll hear on our channel or any of our websites or any of our content, any of our curriculum, any of our courses is a promise or guarantee of results or an expectation of future results, and we don't offer any legal, medical, tax or any other kind of professional advice. Now, what we offer does not constitute a solicitation for you to do exactly what we do, and there's no offer to buy or sell any kind of stocks, futures, or options, or any other financial instruments. Also remember that any financial numbers or any calculations that we show that are referenced on our videos or any of our websites are simply designed to help you better understand concepts. They're designed to illustrate concepts only and should not be considered average earnings, should not be considered exact earnings or promises of any future earnings or actual performance of any portfolio. And finally, please use caution and always consult with financial advisors. Consult with family, friends, other advisors. Do your own research. Come to your own conclusions. Learn how to evaluate. Learn or common terms by checking out other YouTube videos, by checking out other courses. So do all of that before acting on your own. And any information that we provide should not be interpreted as financial advice and should not impact your business and your finances. You alone are responsible and accountable for all the actions that you take. And by continuing to watch this video and any future videos, or by using any of the content in this video, you understand that. And by continuing to watch our videos, you understand this, you agree to this, and you agree not to hold us liable for any decisions, actions, or results at any time under any circumstances, because you may actually lose money. So with that being said, I hope this made sense. Let me show you all the disclaimer items on your screen one more time so you see all of these points, and I appreciate you having the patience to sit through this. Thank you so much for sitting through the disclaimer. Now let's get into my 4-step philosophy, the structure, the cost basis, the target, and the tax implications of your investments. I do believe this has the potential to change your investing capabilities for the better and prepare you for the next pandemic. If you want to be a good investor, it's very important to understand 4 important concepts. The first is structure, the second is cost basis, the third is target, what returns you hope to achieve, and the final and the most important thing is tax implications. These are the 4 extremely important, extremely critical things that you need to know. Let's talk about structure really quick. You need to structure your investments in such a way that you have what are called as core positions or core holdings. This doesn't have to be one stock. This can be a stock in a certain sector, like the utility sector, the technology sector, it can be in the energy sector. You need to be able to identify sectors and stocks that appeal to you. Now, once you identify a core position, the next position is a moonshot position. In other words, it's your Hail Mary. It's something that you hope will just go straight through the roof. Now, for many of us, it's cryptocurrency, it's Bitcoin. I have moonshot stocks, and I'll be talking about those on our channel. And the third, and the really important thing as far as your investments are concerned, as far as the structure of your investments are concerned, is cash flow. You need to be able to actually earn a return through the stocks that you own, either through dividends or through options trading, and that's something I'll talk about on our channel. So as far as structure is concerned, remember there needs to be a core position. It needs to take up 70, 80, 90% of your portfolio. There needs to be a moonshot. Depending on your risk tolerance level, that can be as high as 10% of your overall portfolio. I wouldn't recommend having more than 10% of your overall portfolio in a moonshot stock. So let's say you have $20,000 saved up. You don't want to invest more than $2,000 in something that could be a moonshot, because you need to have that structure, you need to have that core holding. And finally, you need to have cash flow. These things need to generate cash for you. Let's move on to the second important concept, which is the concept of the cost basis. Cost basis basically means what is your average price per share that you bought. So let's say you started buying Apple when it was $110 a share. Let's say you bought 100 shares, and then you bought Apple again at $120 a share and you bought 100 shares. Now your cost basis is $115 per share, because you bought it for $110 one time and then you bought it for $120 another time. So your average is $115. In order to calculate your cost basis per share, just take your overall investment in the shares and divide that by the total number of shares, and you will get your cost basis per share. It's important to bring your cost basis down as much as possible by trying to do your research on companies and buying them when they are priced favorably, and not buying stocks just because you feel they're good stocks. So you need to be able to understand how to value companies and buy shares at a low enough cost basis so you can make money over the long term. The third aspect is the target, what is the annual return you expect to achieve with your stocks, both by way of stock appreciation and also by dividends and options trading that you do. My annual target for my entire portfolio, and something I've consistently done over the past 6 years or so, is 50% a year. Now, the majority of my returns come from the appreciation in the stock, because I'm very careful about picking stocks that appreciate over time. I don't want to sell them and then trigger tax implications. So the majority of the gains of the 50% that I achieve are actually long-term capital gains, because you pay less taxes when you sell a stock after holding it for longer than a year. That's the difference between short-term capital gains and long-term capital gains. So back to the 50% target. You want the majority of your returns to be long-term capital gains, and you will have some portion of those returns, either 10% or 20%, that could be subjected to short-term capital gains tax, where you pay a higher tax rate. And speaking of tax rate, everyone, there's a difference between short-term capital gains tax and long-term capital gains tax. Here's some information on your screen from NerdWallet. What is short-term capital gains tax? Short-term capital gains tax is tax on profits from the sale of an asset held for 1 year or less. Now, your short-term capital gains tax are going to be based on your federal income tax bracket. So basically, if you pay 35% federal income tax, you'll pay 35% short-term capital gains tax. On the other hand, long-term capital gains tax is tax on profits from the sale of assets that you've held for longer than a year. So the long-term capital gains tax can be as low as 0%, can be as high as 20%, depending on your taxable income and your filing status. On your screen, you see the 2020 capital gains tax rates, and this essentially tells you that it makes sense to hold on to assets for longer than a year, and you can hold on to them for longer than a year and benefit from the appreciation if you buy them at a good price and if those companies appreciate. So as you can see on your screen, if your income is up to $40,000 a year, your long-term capital gains tax is zero, which means, let's say you bought a stock for $100 and you sold it next year for $300. Your long-term capital gains tax on that appreciation is zero, as long as your taxable income was under $40,000. Now, this is for single filers. The next tax bracket is quite a big jump, from just over $40,000 all the way to $441,450. If you fall within that income range, then your long-term capital gains tax is 15%. And if you make more than that, above $441,451, your long-term capital gains tax in that case is 20%. So as you can see, it makes sense to hold on to stocks for a longer period of time, because the long-term capital gains tax rate is lower than the short-term capital gains tax rate. So let's go back and highlight the 4 important concepts on your screen one more time: structure, cost basis, target, and tax implications. As far as structure is concerned, I can tell you that my core positions, my biggest holdings, are Apple and Bank of America. My cost basis in Apple is right around $133. I've actually paid a bit more for Apple than I should have, because I didn't quite time it correctly. So my cost basis for Apple is $133. I own tens of thousands of shares of Apple, and also my second biggest holding, Bank of America. My cost basis for Bank of America is $24. My moonshot is Virgin Galactic, because I believe in the future of space travel. I own a lot of Virgin Galactic, and my cost basis for Virgin Galactic is $27. So that is as far as the structure of my investments are concerned. As far as the cost basis is concerned, I already shared that with you. The target, my target from all my investments is 50% a year. So for Apple, I needed to appreciate approximately 30%, go from $133 right to maybe $170, $180 by the end of this year. And the remaining 20% is what I earn through covered calls and through options trading. That was the example with Apple. As far as the other investments are concerned, they've already exceeded the target returns of 40 to 50% for the year. And now, as far as the tax implications are concerned, all the stocks that I own are designed never to sell. I only sell covered calls, I get the dividends, and then I pay short-term capital gains tax on the dividends and on the options trading money that is received from selling options. I sell options for stocks that I already own. I don't buy any options. I am not an options buyer. I simply sell covered calls based on stocks that I own. I sell puts on stocks that I do want to own. So if you want to learn more about my option strategy, let me know in the comment section, and I'll be digging deeper into those. But hopefully this provides you a foundation of how I approach investing: the structure, the cost basis, the target, and the tax implications. You've got to be able to answer all of these questions before you get into an investment. Because if you're not able to answer all of these questions and have a cohesive strategy before you get in, your investing decisions are likely to backfire at some point. Yes, that was my entire investing strategy. That's how I achieve 40 to 50% returns a year. A majority of those returns are long-term capital gains that allow me to pay a lower interest rate because I hold on to my stocks. A majority of my stocks I hold on to for longer than a year. The only time the stocks essentially are subject to short-term capital gains tax outside of the dividends, outside of the covered calls, outside of the options premiums I talked about, are when the stocks actually get called away, or when I get put the stock and then when I sell a covered call and then when it gets called away. Now, as far as option trading is concerned, there are many fantastic YouTube channels out there that go into a lot of detail about options trading, so you can check them out. Now, let me share my portfolio with you and give you a sense of what I'm investing in. So there you have it, folks. This is my watch list. As you can see, I'm a holder of a Virgin Galactic stock. I hold Apple. I hold Bank of America. My two biggest holdings are Apple and Bank of America, followed by Virgin Galactic. You'll see some SPACs here, some special purpose acquisition companies, because I do put part of my portfolio, part of the moonshot component of my portfolio into SPAC. SPACs are special purpose acquisition companies that are then used to invest in other companies. Let's walk you through some of these companies here. HII is Huntington Ingalls Industries. They manufacture ships that are used in war. I'm a big investor in Boeing. I do invest in Cathy Wood's funds. I actually sold some puts today for the genomic fund from ARK Invest. Snowflake is a company I've invested in. There are a couple of banks that you can see: Amazon, Visa, MasterCard, the usual suspects, and the remaining funds are the Cathy Wood fund. So this gives you an idea, folks, of my investments. I'll dig deeper into my average cost basis for every stock. I'll dig deeper into my positions. I'll dig deeper into my exact stock moves. And I'll be doing that in coming videos. So hopefully this gave you an idea on financial preparation for a post-pandemic world, for the next pandemic. I want you to understand the fundamental concepts, because I do believe that this will take you very far as an investor. It's really not important what I'm doing. It's important that you have a cohesive strategy for what you're doing and you feel comfortable with what you're doing. But I'm happy to share what I'm doing in coming videos on my channel. Thank you so much for watching. If you learned something new, please click the like button. Please subscribe. Please enable notifications. That would mean a lot to me personally. I really appreciate you watching. I'm looking forward to seeing you in the next episode of Ignition Time. I'll talk to you soon. Take care. Bye.